In the mid-2000s, the global economy seemed unstoppable. Wall Street was booming. The American dream felt more attainable than ever, and the idea of owning a home was not just a dream, it was a birthright. Banks were offering loans to almost anyone who asked. Real estate prices were soaring, and television shows celebrated the idea of flipping houses for profit. From New York to California, everyone believed the good times would never end. But beneath that surface of prosperity, something dangerous was brewing. A financial system built on greed, illusion, and mathematical fantasies was about to collapse. By 2006, US home prices had doubled in less than a decade. Banks were making billions, fueled by complex financial products few truly understood. Mortgage brokers encouraged people to borrow far more than they could afford, promising that prices would keep rising forever. The phrase, "too big to fail," became an unspoken mantra on Wall Street, a justification for taking ever greater risks. Because if the system was too big to fail, who would ever let it? It all began with the subprime mortgage boom. Traditionally, banks only lent money to people who could prove they could pay it back. But in the years leading up to 2008, that logic disappeared. Banks began approving loans to high-risk borrowers, people with low incomes, unstable jobs, or bad credit. These were called subprime mortgages. At first, they seemed harmless. After all, if a borrower couldn't pay, the bank could always seize the house, which was supposedly rising in value every year. It was a foolproof plan until it wasn't. Behind the scenes, these risky loans were being bundled together into huge financial packages called mortgage-backed securities, MBS. These bundles were then sold to investors around the world. Pension funds, insurance companies, even foreign governments who believed they were buying safe, Pacadidae-rated assets. What they were actually buying was a ticking time bomb. The key players in this game were the investment banks, giants like Lehman Brothers, Goldman Sachs, and Bear Stearns. They didn't just sell these products, they built entire empires on them. Each mortgage was like a brick in a massive tower of speculation. The more loans they issued, the higher their profits climbed. Greed became the engine of the economy. To make matters worse, credit rating agencies, the supposed watchdogs of financial safety, were compromised. Paid by the very banks they were supposed to monitor, they stamped risky securities with top ratings, deceiving investors into thinking everything was fine. The financial system was being poisoned from the inside, but the symptoms hadn't yet appeared. Meanwhile, ordinary Americans were drawn into the illusion. Families bought homes they couldn't afford, convinced that real estate would always go up in value. Construction boomed. Developers built entire neighborhoods on borrowed money, and Wall Street financed it all with borrowed billions. The economy had become a giant pyramid built on trust and paper. By 2007, cracks began to appear. Mortgage defaults started to rise. Homeowners who once believed they were rich on paper suddenly found themselves drowning in debt. As prices stopped rising, refinancing, one of the key ways people stayed afloat, became impossible. The machine that had seemed unstoppable began to choke. In March 2007, two hedge funds at Bear Stearns imploded. They had been heavily invested in mortgage-backed securities, and when the underlying loans started to default, their portfolios were wiped out. It was the first major tremor of an earthquake that was about to shake the entire world. But most people didn't see it coming. On television, analysts reassured the public. They said the system was strong, that the housing market would soft land. The Federal Reserve dismissed concerns, calling it a minor correction. Yet deep inside the vaults of the world's biggest banks, panic was already spreading. Because those who truly understood the system knew one thing. It was all about to come crashing down. By the summer of 2007, the storm was no longer a rumor. It was real. Mortgage defaults were exploding, and the complex financial products tied to them were unraveling at lightning speed. The same institutions that once printed profits were now hemorrhaging losses. Yet the public still didn't understand the scale of what was happening. Because the crisis wasn't just about houses or bad loans, it was about trust. And in finance, once trust breaks, everything else follows. When homeowners stopped paying their mortgages, the domino effect was catastrophic. Those mortgage-backed securities, the supposedly safe investments began losing value overnight. Banks that held billions in these toxic assets could no longer sell them. Liquidity vanished. The same machine that had flooded the system with easy money was now choking on its own creation. The contagion spread fast. In August 2007, BNP Paribas, one of Europe's largest banks, froze 3 of its funds because they couldn't value the assets inside. It was a warning shot heard across the global financial system. The myth that this was just an American housing problem shattered. The entire world had been drinking from the same poisoned well. Investors started to panic. Interbank lending, the quiet backbone of global finance, collapsed as institutions stopped trusting each other. Overnight lending rates spiked, and even the strongest companies struggled to find short-term cash. The system was paralyzed by fear. By early 2008, the first major casualty arrived: Bear Stearns. Once worth $20 billion, the bank collapsed in a matter of days. The Federal Reserve orchestrated an emergency sale to JP Morgan Chase for just $2 a share. It was supposed to be a firewall to contain the panic. Instead, it was proof that no one was safe. Meanwhile, the US government and the Federal Reserve were playing firefighter, pouring money into the system to prevent it from burning down completely. They slashed interest rates, injected billions into banks, and tried to restore confidence. But the damage was already too deep. The architecture of global finance was rotten to its core. The next giant to fall was Lehman Brothers, a 158-year-old institution and one of the oldest names on Wall Street. In September 2008, Lehman filed for bankruptcy with over $600 billion in assets, making it the largest corporate collapse in history. Overnight, markets plunged into chaos. Stocks crashed, credit froze, and within hours, panic spread from New York to Tokyo. People lined up outside banks, terrified their savings might vanish. Lehman's fall was more than a bankruptcy. It was a symbol. It showed that the guardians of global finance had lost control. Hedge funds scrambled to unwind their positions, corporations halted spending, and the global economy entered free fall. Within weeks, the financial system stood on the edge of total collapse. To prevent the unthinkable, the US government took extraordinary measures. They bailed out AIG, the world's largest insurance company, to stop another domino from falling. Then came the Troubled Asset Relief Program, TARP, a $700 billion plan to rescue the banks that had caused the disaster. It was one of the most controversial decisions in modern history. Ordinary citizens were furious. The same institutions that had gambled recklessly were now being saved by taxpayers. Families were losing their homes, jobs were vanishing, and yet Wall Street executives continued to collect bonuses. The anger that followed reshaped politics, culture, and trust for an entire generation. In just a few months, global wealth evaporated. Trillions vanished from markets and unemployment soared worldwide. For millions, it felt as if the world had changed overnight. But for those who understood the system, it wasn't an accident. It was the result of decades of deliberate risk, deregulation, and greed. The 2008 financial crisis wasn't a single event. It was the inevitable collapse of a structure built on illusion. As the smoke rose from the ruins of Lehman Brothers, the US government was facing an impossible choice: let the system collapse or save the very institutions that had caused the catastrophe. In theory, capitalism punishes failure. In practice, these banks were so deeply woven into the global economy that their destruction could take the entire world down with them. So, one by one, the government began writing checks. Massive, historic, and unprecedented. The $700 billion TARP program was sold to the public as a necessary evil. Officials claimed that if they didn't act, ATMs could stop working, salaries might not be paid, and the modern financial system could cease to function. It was the ultimate too big to fail moment. And though the bailout prevented a complete collapse, it came with a hidden cost. It confirmed to the world that in the modern economy, risk and responsibility were no longer connected. While Wall Street was rescued, Main Street was left to drown. Millions of Americans lost their homes. Entire neighborhoods turned into ghost towns. Families who had worked their entire lives to own a house watched everything vanish in weeks. The eviction notices piled up while the architects of the crisis sat before Congress, offering apologies without consequences. Some were even rewarded with new bonuses, citing the need to retain talent. It was a cruel irony that burned into the public's memory, but the shockwaves went far beyond the United States. Europe was hit hard. Banks in the United Kingdom, Germany, and Iceland were heavily exposed to toxic U.S. assets. Governments across the continent scrambled to nationalize failing institutions and inject billions in liquidity. The crisis became global, proving that the world's financial systems were not independent but deeply intertwined. Like dominoes standing in a single line, the stock markets reflected the chaos. Between October 2007 and March 2009, the Dow Jones lost more than half its value. Retirement savings evaporated, and consumer confidence hit record lows. The idea that the market always goes up had been shattered. Decades of trust in financial institutions dissolved overnight. The political consequences were just as profound. In America, the outrage fueled the rise of movements on both extremes of the political spectrum. People who felt abandoned, betrayed, and powerless. Occupy Wall Street became a global protest, a symbol of defiance against the elites who had gambled with the world's future. The phrase, "We are the 99%," entered history as a cry for justice in a system that had rewarded recklessness and punished innocence. At the same time, new narratives began to take hold. Some blamed the government for allowing reckless lending. Others blamed deregulation and corporate greed. Economists argued endlessly over what went wrong, but ordinary people didn't need theories. They had lived the reality. They had seen the banks collapse, their savings shrink, and their jobs disappear. The trust that held the economy together was gone, replaced by suspicion and fear. The U.S. Federal Reserve launched quantitative easing, a policy that involved printing vast amounts of new money to buy government bonds and mortgage-backed securities. The goal was to inject liquidity and keep the economy alive, but in doing so, it also inflated the prices of assets like stocks and real estate, widening the gap between the wealthy and everyone else. The rich, once again, were rescued first. By 2010, the technical crisis was over. The markets were recovering, banks were reporting record profits again, and headlines declared that stability had returned. But beneath the surface, something fundamental had changed. The moral foundation of capitalism, the belief that risk and reward are linked, had been permanently severed. The system had survived, but at the cost of its legitimacy. Governments around the world promised reform. They swore that nothing like 2008 would ever happen again. Laws were written, regulations strengthened, oversight increased. Yet as the years passed, the same behaviors crept back into the system. Complex derivatives returned, speculative bubbles inflated once more, and Wall Street bonuses reached new heights. The lesson had not been learned, it had been monetized. In the years that followed the crash, something extraordinary happened. The same system that had almost destroyed itself came back stronger than ever, at least for those at the top. Central banks kept interest rates near zero, pumping cheap money into the economy in the hope that it would spark growth. But instead of reaching the middle class, most of that money flowed back into the stock market, into real estate, and into the hands of investors. The rescue that was meant for the people became a windfall for the elite. The data told a story no politician wanted to admit. By 2015, the top 1% of Americans owned more wealth than the bottom 90% combined. The richest became richer than ever, while the wages of ordinary workers stagnated. Inequality, once considered an economic problem, became a political time bomb. And yet, the narrative repeated itself. Growth was back, markets were booming, unemployment was low. The headlines celebrated recovery, but the streets told another story. Homeownership, once the symbol of the American dream, never fully recovered. Millions who lost their homes during the crash could not return to the market. Entire generations were priced out as investment firms bought properties in bulk, turning neighborhoods into rental empires. What had once been a path to stability became a trap of permanent rent and debt. Meanwhile, the political landscape shifted dramatically. The crisis destroyed faith in traditional institutions, and gave birth to new populist movements around the world. From the Tea Party in the US to the anti-austerity protests in Europe, citizens were rising up against what they saw as a rigged system. Trust in banks, governments, and even democracy itself began to crumble. In Europe, the aftermath took a darker turn. Countries like Greece, Spain, and Italy faced sovereign debt crises triggered by the same financial contagion. Greece, in particular, became the epicenter of economic pain, forced into harsh austerity measures that crippled its economy for a generation. The promise of European unity turned into a decade of division, resentment, and political turmoil. Across the Atlantic, Wall Street reinvented itself. The very institutions that had been bailed out began to merge, consolidate, and expand. Instead of shrinking, they grew larger and more powerful than before. The phrase "too big to fail" evolved into something new. Too powerful to challenge. The concentration of wealth and influence became the new normal. Technology also played its part. High-frequency trading, algorithmic systems, and automated markets replaced human traders. Finance became faster, colder, and more detached from reality. The line between economics and engineering blurred, as profits were extracted not from innovation or production, but from microsecond advantages in the flow of money. And beneath it all, a new asset began to rise, one born from the ashes of the collapse. In 2009, a mysterious figure known as Satoshi Nakamoto published a paper introducing Bitcoin, a decentralized form of money that operated outside the reach of governments and banks. It was not a coincidence. Bitcoin was a direct reaction to the betrayal of 2008, a protest encoded in software. For the first time, people could imagine a financial system not controlled by the same institutions that had failed them. But while the world debated new currencies, the old system adapted. Governments learned that printing money could be done without consequence as long as confidence remained. The global economy entered an age of artificial stability, an era where central banks controlled the heartbeat of markets and where crashes could be postponed, but never truly prevented. By the end of the 2010s, the scars of 2008 were still visible, even if buried under record stock prices. The recovery had been uneven, fragile, and built once again on debt. The question was no longer whether another crisis would come. It was when and whether the world would survive the next one. 15 years after the crash, the memory of 2008 has faded for many, but the architecture it left behind still defines the modern world. The system was rebuilt on the same foundations, only now they are deeper, more complex, and harder to see. The banks survived, the markets recovered, and politicians declared victory. Yet beneath the headlines of progress, the same sickness continues to grow. Debt, speculation, and the illusion of control. The financial crisis of 2008 was not an accident. It was a revelation. It showed the world that the economy most people depend on is not designed to protect them. It's designed to protect itself. The institutions that were rescued are the same ones that continue to shape policy, influence governments, and dominate the flow of global capital. Every bailout, every rescue, every emergency intervention reinforced one message. Risk is rewarded, responsibility is optional. When the next crisis comes, and it will, it may not begin in the same way. It might not be mortgages this time. It could be corporate debt, sovereign bonds, or digital currencies. But the pattern will be familiar. Greed will build the bubble. Fear will burst it. And ordinary people will once again be asked to pay the price. Some argue that the world is stronger now, that regulations have improved, that banks hold more capital and risks are better understood. But history has a way of disguising repetition as progress. Each generation believes it has outsmarted the past, right up until the moment the past returns. What truly changed after 2008 wasn't the system. It was the psychology of a generation. Millions lost faith in institutions. They stopped believing that governments were neutral arbiters of justice. They realized that, in a crisis, power protects itself first. That realization reshaped everything from politics to technology, from the rise of Bitcoin to the revolt of retail investors who use the stock market as their battleground. The story of 2008 didn't end with the recovery, it simply evolved. The irony of the crisis is that the more money was printed to fix it, the more fragile the world became. The same cheap credit that once fueled the housing bubble is now embedded everywhere, in government debt, corporate bonds, and household spending. Global debt has tripled since 2008. Every economic boom now depends on the next round of borrowing. What was once a dangerous exception has become a permanent strategy. For those who lived through it, 2008 was a moment of fear. For those born after it, it's history. But the lessons are not abstract. They're alive in every decision made today. The next time markets crash, the next time currencies falter, remember what happened when trust disappeared in 2008. Remember how fast the impossible became inevitable. The story of the financial crisis is not just about banks or numbers, it's about human nature. It's about how greed blinds, how denial delays, and how systems built on arrogance always collapse. The cycle repeats because we never really learn, and yet every collapse offers a choice: to rebuild differently or to rebuild the same. If this gave you a new perspective, hit subscribe. History has the answers, you just have to look closely enough to see them.